Joining us right now in the markets, today's jobs data and next week's Fed meeting is Matthew Rowe, Senior Portfolio Manager and Head of Cross-Asset Strategies at Nomura. Also, Veronica Clark, who's an economist at Citi. And Veronica, why don't we start with you, just the reality of where you think the economy's headed, what we might hear with the jobs report today.
Yeah, I think we're going to get 195,000 this morning. That's still a really robust pace of job growth. Worth noting that we do have some returning striking workers in this employment report today. But I think the overwhelming story is still that the labor market is strong. The economy is resilient, but we are starting to see some signs that cracks are forming. I think the most important thing to watch today is the unemployment rate. That has been ticking up some, and if those cracks really start to build and we start to see layoffs, not just slowing hiring, we are still thinking that we're headed for a recession next year.
If we do see a very strong number, as you just mentioned, if there are people coming back from strikes and that kind of looks at a strong job market, what would the reaction from economists at least be that, wait, maybe this slowdown is further off than we thought?
Yeah, I don't know if I would read too much into just one employment report just yet, especially because, a weakening in the labor market, there really can be some non-linearity to that. It could accelerate relatively quickly. But markets, of course, are pricing relatively near-term cuts for the Fed. And if we do get a robust number today, maybe we push that pricing out a little bit.
And Matt, that's where the big rub comes down on all of this. You could be looking at a number that, no matter what it is not going to be pleasing enough to the market, given the big gains we've already seen in the expectation that the market is looking for these cuts sooner rather than later.
Yeah, I think, ever since the sell-off that sort of hit the bottom in October 27th, just ahead of Halloween, we've seen a massive rebound in risk pricing. And my view on this is that the fast twitch response of risk markets, whether it be equities, credit, observations through to volatility, it's all pointing towards a very optimistic look at rapid rate cuts. I think people shouldn't lose focus on the commentary from the Fed that there's policy work that's done just maintaining a higher level of rate on a static basis. I don't think that the Fed is likely to just flinch and try to support what is already seen as a bit of a problematic bubble in real estate of sorts. So, my view on it is that we're probably a little over our skis, as they say, as far as the rebound going into year end here, and a little bit over optimistic on the look through to the impact of this.
So have you been holding off on allocating any more money into equities at this point?
Yeah, I mean, from a relative value perspective, I think equities are relatively unattractive. I think if you think about my view on it is all forms of long risk or short volatility trades, and you just have to figure out how you're being compensated for being short volatility. The equity value proposition right now, as compared to credit, doesn't look as good. I think if you look at it in classic cap structure terms, equity is a call option on the assets of a company above and beyond that which debt holders have a claim to. So if you can get secured attachment, if you can start putting money to work at relatively attractive levels as a credit investor, and you don't have that big downtail, I think that's relatively very attractive right now.
Okay, Veronica, the things you'd be expecting just in terms of when you think the Fed might actually cut rates, if the market is ahead of itself and thinking it's going to be, I don't know, by March or April, what are you thinking?
Yeah, I think we're looking at the path that we see for inflation data over the next 6 months, and it still looks pretty strong to us, stronger than 2% kind of underlying inflation. So I really do think it will have to be weaker activity data that get the Fed to be cutting. I do think we'll see that, as we're getting on towards the middle of next year, probably not, quite as soon as Q1, but we are still penciling in a recession. So we do have our first Fed cut in July of next year.
Matt, Veronica pointed out that we should look at the unemployment rate overall, but what about average hourly earnings? I would assume the market's going to dig into that pretty deeply, too, if it suggests that inflation's stronger.
Yeah, I mean, I think if you look through to the employment situation as it relates to companies, you also have the higher cost of capital aspect of what the flow through of the rising rates that we've had over the last year and a half, and that has backed off recently. I think a lot of the optimism out of the equity market is coming from the fact that we've seen this rapid contraction in rates, which is bringing down the cost of capital. And I should say also not just rates coming down over the last month, but also credit spreads narrowing very, very quickly in tandem with this risk rally. So there's a lot of relief at the company level if they're having some form of friction in the labor markets. They're also getting a lot of relief in this rapid decrease in cost of capital.